The optional strategy is a powerful technique you can use to generate consistent weekly and monthly cash flows, as you're going to see in this video. This is a strategy I've been trading for many years, and it's put hundreds of thousands of dollars into my pocket. In this video, I'm going to share with you 4 real-life examples of positions I've been trading the optional strategy over the past several years. I picked some of the worst positions possible because I want you to show how even when positions go against you, you can still generate awesome cash flow returns using the optional strategy. In the end, you can decide if this is a strategy that you want to have as a piece of your portfolio. For those that are new, I'm first going to briefly tell you what the optional strategy is, and then we're going to get right into my 4 positions. Simply put, the optional strategy is where you sell a cash or put option against a stock you'd feel comfortable owning if that put option was assigned to you. Here's an example of a stock that I have a position in right now, DLR. Currently, the market's closed, but on Friday, DLR closed out at just over $157 per share. Step 1 of the optional strategy is to sell a put option at a strike price you'd feel comfortable owning the stock at. Let's say I feel comfortable owning DLR at $150 per share. In that instance, I would consider selling a $150 cash or put option that expired at some point in the future. Personally, I like to trade 20 to 60 day options, and generally I like to trade around 30 to 50 day options. But each trader has to decide what time frame they want to sell that put option in for themselves. There's a lot of things you can do once you sell this 150 put option. I won't go into a lot of detail about what you can do. I have a whole video series dedicated to that. But simply the process is you sell this put option and then you wait. At expiration, if the stock is above this 150 put option, nothing happens. You keep the premium and you can do it all over again. But if the stock were, say, to come down to, let's say it's 145 area, at that point that put option will be in the money. So if you didn't do anything, the put option will be assigned to you. So you'd buy 100 shares of DLR at 150 per share for each put option contract that you've sold. That's when step 2 of the will process kicks in. At that point, you sell a cover call against the 100 shares of stock that you own. Most traders want to sell it for at least what they paid for it, so you might consider selling that same 150 cover call option. So what stocks should you be doing the will strategy in? I like to do them in companies I believe are either fairly valued or, even better, companies that are undervalued or selling for a lower price than I think they should be from a fundamental standpoint. I like those companies to have some history behind them. I want them to be mature. I also want them to be consistently profitable. I want to see that they are a well-run company. And the reason for that is that when you sell a put option, if it's assigned to you, you actually own a piece of this company. So you like to buy that company at a cheaper price than what it should be selling for, and you want to invest in a company that's consistently profitable and has some nice history behind it. Currently, my potential trade list is over 225 stocks and ETFs. These are all companies that I've researched and feel comfortable owning them if the put options were assigned to me. Now, that's not my goal when I trade options, but with the optional strategy, that is a very real possibility. And indeed, I do have several positions that have been assigned to me right now. I'm going to share 4 of them with you here in just a second. So that's the optional strategy. You sell a put option. If it's assigned, you then turn it into a cover call. Now let me share with you 4 positions that actually went against me, some of them in a big way, so you can see how much cash flow and profit you can make by trading the will strategy. Before I share all the numbers with you on this position, let me first give you the lay of the land. Let me show you the charts of DLR from the time I've been trading this position. This is a weekly chart of DLR. It covers about the past 3 years of its stock price history. Each one of these bars is the equivalent to the action that week. Now notice the stock price history during this time frame. Going back to early January, about 2.5, getting close to 3 years ago, the stock was trading for around $176. Then over the next year and a half, it experienced a sharp decline of right at 50%. I think you'll agree with me, that defines a position that's gone against you. But then from that point, a little over a year ago, the stock has had a nice advance. It's advanced about 85%, so it's almost back to where it was all the way back here when we first started trading it, but a little bit less. Remember, it was trading for about $177 per share back when we started trading it, and now it's trading for around $160 per share. But what does our P&L and our cash flow look like during this time frame? Now we get to the exciting stuff, the numbers. I remember when I first started trading options that I used to love seeing things like this because option trading was so new to me. I had no idea how much cash flow I could generate by selling options. So here's the history of the past about 4.5 years in all my option trades in DLR in my main account. Today is about 3 months shy of 6 years when we first started trading it on this spreadsheet. So notice what's happened over the past about 6 years. So notice that for a long time we were just trading one contract in this account. My account was a lot smaller then, and since then I've added money to it and the account has grown. Just keep that in mind that it was a lot smaller account years ago. But as I scroll down here, you see all these put options that I've sold. Finally, in that area where I showed you on the graph, around May 20th of 2022, we're assigned 200 shares of DLR. Since we had sold the 140 put option, we bought 200 shares of DLR at $140 per share. Then we began to sell covered calls against DLR. But notice the strike prices that we were selling. Remember, we paid $140 for the stock because that was the strike price of the put options that we had just sold. But remember, DLR had a 50% price decline from its high several years back. It reached a low of around $90 per share. If we were trying to sell that $140 call option, we wouldn't receive hardly anything for it. So to help prepare the position, I was selling call options below the price that I was assigned the stock at. But I also knew what my risk was. I knew there was always the possibility that if DLR experienced a sharp increase in price, the stock might be called away from me at a price lower than what I bought the stock at. So notice the strike prices I was selling those covered calls at. All these STOCs, that's sold to open call option. In this case, sold to open a call option. So now I'm going to move the Excel spreadsheet up so you can see the more recent time frames. Notice the strike price of these covered call options I've been selling. It started out higher, around $135 per share. As the stock continued to decline, which remember got down to around $90 per share, we lowered our covered call strike price. Indeed, we got all the way down to $90 per share in October of 2022. Then I believe that DLR, the stock price, began to bottom out. And here's where position sizing is very important. If you've been watching my channel for a while, you know my position sizing. I want to have at most at risk in any one underlying stock like DLR, 5% of my overall portfolio. That means if all the put options I had sold were assigned to me, including the covered calls I already owned, I'd want that to be at most 5% of the value of that portfolio. But my initial position sizing rule is to have at risk initially only 2.5% to 3%. You see, that leaves me 2 to 2.5% left to prepare a position like DLR and like the other thing I'm going to share with you in this video if they go against me. So once I believe that DLR had bottomed out, in addition to that covered call I was selling, I began to sell additional cash secure put options against it. And because I owned a covered call, I owned the stock, you see I also began to collect that nice dividend, which with DLR, it was a nice dividend. It was $1.22 per quarter. So that really added to my cash flow. Here you see my current position in DLR. On the bottom, you see we own 200 shares of DLR. That's the shares that were assigned to us several years ago. And our covered call, as you see here, expires in January, is the 130 covered call that expires in January. That expires in about 100 days from now. Then the additional cash secure put options we've been selling, well, those expire on that same day, January 17th, and they're at the 125 strike price. So we're short the 125 cash secure put options, and we're in the 130 covered call. But remember, we bought this stock at $140 per share. Before I show you the P&L and cash flow, let me remind you what the chart looks like. Currently, DLR is trading for around $157 per share. So the cash secure put option we sold is way down here at $125 per share, or about 20% out of the money. And the covered call option is at $130, which it is about 17% below where the stock's currently trading at. And we bought this stock at $140 per share several years ago. Now let's look at our cash flow and P&L if the position closed out today. Remember, we bought the stock at $140 per share, and we've sold the $130 cover call option. So we would actually have a loss in that position on just the stock of $2,000 for just the shares. But we have collected a ton of option premium and dividends, as you're going to see here. Now I've scrolled down to the bottom of the spreadsheet that shows all our DLR trades of the past several years in this one account. Notice that if this position was closed out, the 130 cover call option was assigned, and the 125 put option expired worthless, we'd have a cash flow of over $12,722 in this one position. If you break that down per share for the 200 covered call shares that we own, we have a profit of over $63 per share. And that's running the option wheel strategy over the past several years in a company that had a price decline of 50%. One reason I felt comfortable staying in this position, even though it went against us, is that nothing had really fundamentally changed with DLR. The stock price just got hammered for several years. So I still felt like I was trading in a good, solid company. And as you see, eventually the market agreed with me. Now, if something had fundamentally changed with DLR, I would have been out. But since nothing had fundamentally changed with DLR, I was willing to stick with it for the long term. As you see, it worked out really well for us. Because you might potentially own a piece of these companies for a long time if the position goes against you, that's why I encourage you to only trade in fairly valued, or even better, undervalued companies. And that's what I do in my main option trading account and in my small option trading account. I'm only trading companies I believe are fairly valued, or even better, undervalued. The way if I get stuck with them, I feel like I'm being stuck with a great deal. So how do you manage these positions? When should you roll your covered calls or roll your cash secure put options? One of my rules is if the stock hasn't been assigned to me, I like to try to avoid earnings if at all possible. So if I can close a position out for a profit or even break even to avoid earnings the next month, that's what I do. But if I own a covered call, I tend to stick with a position even if it's about to go through earnings. The other trigger for me is to adjust or close out options when I've realized about 80% of their potential profit. If it's a covered call, then at that point, I begin to look to roll that covered call out to a future date. If it's a cash secure put option, I decide if I want to roll that out or just close it out altogether. So when there's only 20% of time value left in the option I've sold, I look to begin to close it out or to adjust it. Here you see another position I've been trading the wheel strategy and that's gone against me. Now understand, we have a lot of positions that have gone our way. I'm intentionally showing you the worst of the past several years. This is another real estate company where the position went against me. We started trading it back in May of 2021. Notice that a really sharp price increase of right at 60%. But from there, the stock just plummeted. It ended up being down right at 75%. Since that time, it's been experiencing a nice increase. So now it's up 80% from its low. So all that up and down, but what's happened to our P&L? Here you see a spreadsheet with all the trades we've done against IIPR in this account. Now get down here to the bottom, pay attention to these numbers here. But in spite of all that up and down, if the position closed out right now where we're at today, I have a profit of almost $7,700. If we break that down per share for the 200 covered call shares that I own, we have a profit of over $38 per share. And that's in stock that's been all over the place. Here's another optional stock I've been trading over the past about 4.5 years, and that's Tyson Chicken. We started trading it right after the big COVID crash in 2020. Notice on this weekly chart that it had a nice price increase over the next couple of years of around 63%. But then it had a big old-fashioned decline of around 50% over the next couple of years. Since that time, it has recovered some and it's now trading for around $60 per share. So as you see, over the past 4.5 years, it's pretty much trading sideways from where it was when I first started trading it right after the big COVID crash. But what does our P&L and cash flow look like during that time? In spite of this wild roller coaster, but notice as I get down here to the bottom, we put a net of over $11,000 in this one stock that we've been running the optional strategy in. If you break that down by the 600 shares that we currently have sold covered calls against, it's a profit of just over $18 per share. And that's a stock that's pretty much traded sideways over the past 4.5 years. As I pull this last chart up, I do want to mention one thing about these positions. Although I'm showing you cash flow the past multiple year time frame, just keep in mind that we weren't always in these positions 100% of the time. Especially during times where we didn't own shares and weren't doing covered calls, we would trade in and out of these positions and try and avoid earnings if at all possible. During times when we didn't own stock and therefore didn't have covered calls, we'd trade in and out of the cash care put options. Remember, I try and avoid earnings, so many times we wouldn't be in these positions at all if we didn't own shares and weren't doing covered calls. We'd be out of cash care put options and then go back in after the earnings date. But overall, these are positions we've actively traded over the past multiple year time frames. Now I'm going to share one more with you. It's probably one you've heard of, which is Texas Instrument, ticker symbol TXN. Now we started trading this one back in 2018. It was towards the end of 2018. As you see, the stock had a nice decline, was finding support around this red 200 moving average on this weekly chart. So our timing was great. And since then, overall, it's had a really nice price increase. I mean, it's way up from $100 per share to $200 per share. So it's basically doubled over that time frame. But during that time frame, it has been quite the roller coaster ride. If you like roller coasters, you can strap yourself on because this thing was a wild roller coaster ride. Because this wild roller coaster ride, there were times when I believe the stock was overvalued. So there were extended periods of time where I didn't trade any options at all in Texas Instrument. But we also did quite a few trades in them. So let me show you our P&L and what our spreadsheet looks like. So here you see our trades going all the way back to 2018. And we did multiple trades. They were all smaller trades because remember I had a smaller count back then. They were mainly one contract size trades. And we did that from the end of 2018 to about the middle of 2020. And going back to our chart here, that's a time when Texas Instrument's price really went way up. It increased about 100% over the next year and a half. In my opinion, it was overvalued based on its fundamentals. So I didn't make any trades in it. So as you see here, between May of 2020 and January of 2023, I didn't place any option trades in Texas Instrument in this main option trading account. However, since May of 23, I've been trading cash secure put options, and when they were assigned to me, covered calls against Texas Instrument. So this one's a little bit different than the other three. I've been trading in and out of Texas Instrument, so we don't have as many trades or as much time in this stock, but still notice our profit and loss down here at the bottom. In this one position where at times we've been out for almost 2 years, we still have a net profit of over $4,700. When you break that down by the 300 shares of covered calls worth that we're in, we have a profit right at $16 per share. This is a stock we traded in and out of over the past several years. And at one point, this stock went against us in a big way. But as you see, trading the wheel strategy has produced really nice cash flow returns and all 4 of these positions that at one point, all 4 of them went against us. Trading the optional strategy is a technique you can use to consistently generate awesome cash flow return as you see in this video. It's very important to pick the right stocks and to exit them at the right time. But if done properly, the optional strategy can put consistent cash in your pocket every single month. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. Knowing how to repair option positions that go against you is a very important tool you must have in your tool bag. If you'd like to see some of my favorite tips and tricks that I use to repair positions that go against me, check out the video series at the link above and the description below entitled Option Repair Strategies. Until next time, happy investing, and we'll see you again soon.